Hey everyone, welcome back to Invest with Corey. Before we get into today's video, if you're enjoying the content, be sure to subscribe and tap the bell so you know when I post new videos. You know what the one thing that you don't need any capital for? That's right, to give me a thumbs up. It's free. It's absolutely free, and it doesn't cost you any investment. If you have any questions, leave them below, as I take pride in answering all of your questions, as I want to really help you grow your portfolio and help you live a better life. That is the reason why I started this channel, is I really want to help other people reap the benefits of financial freedom like I've been able to do. From blowing up small accounts to medium accounts to learning and going to college and spending years doing this, I have learned the proper way to trade and the safe, consistent way to trade. And this has allowed me financial freedom, and it's allowed me to live a much better life, and I want to help you guys to be able to achieve the exact same goal. I've said this before, but I'm not a financial advisor, and this isn't financial advice. I'm just coaching you guys on strategies, and it's up to you which companies you choose to invest in and how much capital you're risking in each trade. Those are all your decisions. I am just coaching you on the strategies, trying to help you get better at this. Really excited to share this strategy with you, because nothing's a better feeling knowing that you have the opportunity to make money in the stock market, even in a stock that you otherwise wouldn't be able to afford to do. And it's a very empowering moment to be able to say, hey, I can afford to do this because I have a strategy to get in where I otherwise wouldn't be able to do it. And nothing feels better knowing you've got opportunity. And a lot of the times I've been in that position where I couldn't afford to sell options on a stock. And to be able to do this is so awesome. And I'm sharing it with you guys. Nothing's better than the feeling of financial freedom and being able to grow and educate yourself and get better at doing something. And I'm very happy and excited to share this with you guys. Today's strategy is one of my favorite strategies. This is really one of the best strategies. I love it because it allowed me to grow a small portfolio of just $300 into almost $10,000 that I'm currently trading on right now in only 3.5 months. And I'm going to show you guys exactly what that strategy is right now, because it is such a powerful tool to have in your toolbox. If you know how to enter and exit trades with this strategy properly, you can make a boatload of money. So I want to show you guys how you can sell puts on stocks that are way more expensive than you can afford. So if you have a small account, less than $10,000 or $20,000, but you want to sell puts on stocks that are $200, $300, even $1,000, I'm going to show you exactly how you can do that. So we're looking at Meta today. So let's say after looking at a chart and a Bollinger Band, we determined that Meta is not going to go below $480, and we want to sell this $480 put. We're going to click on sell, click on put, pick our expiration date, and if you're looking at this in the future, the strategy is the same no matter the expiration date. So we've selected put. We're going to sell a 480, but then there's a little bit of a problem. We click on continue. Let's say you don't have a large portfolio and you only have $5,000 or $10,000. You won't be able to sell a Meta put, because in order to sell a put on Meta at $480, you would need to have $48,000 in your account. And most people don't have $48,000 just lying around. In fact, even people with a $200,000 or $300,000 portfolio most likely don't have $48,000 just sitting around free and open to spend on whatever they want. So this is a very tricky situation, but there's a fix for this to show you guys exactly how you can execute this put without needing $48,000. And I'll show you what I mean. When I click review, you see how it says $48,000 collateral, and you probably don't have $48,000. What if I told you you could execute this trade with only $1,000 or even $500? Heck, you could even do it for $250. Let me show you exactly how to do that. This way, you guys can have the opportunity to sell puts on stocks that are too expensive for your portfolio, giving you the opportunity to capitalize on larger stocks, bigger price action and movements, and implied volatility to help grow your portfolio a lot faster. We're going to sell the put like we normally would, clicking on the 480 put. Now that we've done this, we're going to go ahead and we're going to click on buy put with the same expiration, and we're going to come down 2 legs to 470 and click buy. What we've done is we have hedged our position. This way we don't need $48,000 collateral. In fact, we only need $717 collateral, because what we've done is if Meta goes below 480, we no longer have to worry about buying the shares for $48,000, as this put we're buying right here at 470 is hedging the position. So if Meta goes below $470, max loss would be $717, and this put right here would cover us. We wouldn't have to do anything. We cannot lose any more than $717 on this trade versus $48,000 on just selling a put on Meta. Do you see how much less capital it takes to execute this trade? And look at the profit. We will collect a $283 premium for selling this option. So instead of risking $47,570 to make $430, which is less than 1% return, we are now going to be making $283 on $717, or $1,000 total because it's $1,000 spread. This is a 20% return. Actually, it's a 27% return versus 1% return, which is insane. Risking $48,000 for $430, yet we can make $283 by risking $717. This is a much better situation. But we're gonna bring up TradingView and look at Meta and figure out where we think Meta is actually going to go, because that would be an aggressive play. If I was to sell a $480 put credit spread like I'm doing here, I would have to be sure that Meta would stay above 480. You could even play this more aggressive. You could sell a 485 and buy a 475, which would allow you to make $324 out of $1,000, which is a 35% return. Your max loss would be $676. You cannot lose any more than $676, no matter what happens here, unless you get pinned between the strikes, which is very important. I'm gonna explain that in a few minutes. You don't wanna get pinned in between the strikes. Your brokerage won't allow it. Unless you have the money to cover it, then you're not really at risk because you'd end up buying Meta anyway. So it's not a real concern because this is a small portfolio strategy. However, I'll explain that in just a minute. If we were to believe that Meta was going to be above, let's say 500 for the week, we felt Meta is going to come back up and go above 500. You can also set it up like that and say, well, I think Meta is going to go above 500, so I'm going to sell a 495 and I'm going to buy a 485 right here. This would give you a $668 return with only risking $332. This is a very good way to sell a put credit spread, because if you're confident that the stock is going to go up, you're only risking $300 to make $600. This is a very good strategy if you are bullish on a stock. If I'm not bullish on this stock, I feel like the stock is not going to go up, but I feel like it's going to stay the same or go up just a little bit or even come down a little bit, but it's not really going to do a whole lot. And I just expect it to stay generally where it's at right now. What I will do is I will sell a put that's a little bit below, and I'll go over to TradingView. I'm going to look at the Bollinger Bands on the daily chart. We got the length of 20, deviation of 2, and this daily chart right here is good for 1 week out. If you want to go 2 weeks, 3 weeks, or a month out, you have to use the weekly chart. And as you can see, the Bollinger Bands is telling us we have 96% chance that the stock is going to stay between 481 and 513. In this situation, because we're at the bottom of the Bollinger Bands and we're starting to get ready to touch, likely it's going to bounce off that. Monday, I expect Meta is going to drop a little bit in the pre-hours, and when the opening bell happens, we're going to dip into the bottom of the Bollinger Band. At some point Monday, we're going to start rebounding, and I expect next week we're going to end up back somewhere in the 490 range. It would be safe for us to sell a 480 put on Meta. I don't think Meta is going to go below 480 this week. It could, but to be safe, we'll even drop it down to 475, which is very safe considering the Bollinger Band at 481. I think 475 is very safe. So we'll go back over here. So we'll go back over to Meta. 475 is where we're going to sell the put. 78% chance. The Bollinger Band illustrates that we should be good with this trade, and it's highly likely, but the delta is 25, which is a little high for a stock like Meta, even though the volatility is 26%. It's not very high. The delta is a little too high for my liking, but it could pay out a good premium. 256. We buy the leg at 465, which is 1,000 below, and $167 profit, which is a 16% return. This is a very good trade, but if you want to play it a lot safer, which I would do, because in this channel, my goal is to teach you consistency with low risk strategies, or at least as low of a risk as possible. So we're going to do this a little bit better. It's not going to be as much of a profit, but it's going to be a lot safer. So what we're going to do is, instead of selling the 475, we're going to sell the 465, and then we're going to buy the 455. This is going to be a $60 play. Now, you might be thinking, Corey, this is only $60. I could be making 180. I understand that, but the chances of Meta hitting 475 are somewhat low. The chances of Meta hitting 465 is highly unlikely. I would rather make $60 with almost no worry. So it really is up to you on your tolerance of risk. However, for myself, I would much rather sell the 465, as Meta would have to drop $21 in 5 days, and that is a little bit out of the realm of possibility. If the stock price stays above $475, you keep the premium and you don't have to do anything about it. However, if it drops below 475, then you're losing money. And if it continues to drop and you, for whatever reason, don't manage the position and it drops below 465, then you don't have to do anything. Both positions expire and cancel each other out. This 465 would cover the 475. You would get assigned and then exercise simultaneously. You wouldn't have to do anything. Your max loss would be $833. You wouldn't have to do anything. However, getting pinned between the strikes is where the problem is. If the strike price of Meta drops below $475, but stays above $465, let's say it stays right around $470, your purchased put at $465 will not hedge you anymore. It will not cover you from assignment. So on expiration day, if you let this credit spread expire and Meta is sitting at 470 and it's in between your two puts, then you're going to get assigned and you're going to have to pay out of pocket $47,500. However, I wouldn't be alarmed, as your brokerage will not allow this to happen if you don't have the $47,000 in your account, which you probably don't, considering you're running the small account strategy anyway. Your brokerage will just close it out for you at a loss. So I highly recommend by 3:15 p.m., some brokerages 3:30 p.m., closing your own put credit spread for a loss if you have to, as you're not going to be able to close this put credit spread at 3:55 p.m. as you would if you had the money to cover it. They're not going to allow you to run this credit spread to the last minute, because if you were able to do that, you would lose less money because of theta decay, but they're not going to take that risk if you don't have the capital. If you are pinned in between puts or in between the strikes on the credit spread, that is the worst position to be in. You don't want to be pinned between 475 and 465 in between these two legs. Anywhere between 465 and 475 is bad. Anywhere above 475 or below 465, they both expire. One, you expire with a max loss of $800. The other, you expire keeping the premium. However, if you expire in between, you get assigned, and your brokerage won't allow that anyway. So it's best for you to close the put credit spread on your own, reopen a new one. I'm very happy I was able to share this strategy with you guys and show you how you can get into a stock that you otherwise wouldn't be able to afford by just hedging your position a few strikes below the put that you're selling. Really an awesome strategy, and I'm so happy to be able to share it with you guys. If you guys have any questions about the strategies that I'm teaching you, be sure to comment below and give me a thumbs up if this video helped you, and be sure to subscribe and tap the bell if you enjoy the content in this channel. We're doing this one step at a time, and my goal is to teach you how to become profitable or help increase your profits so we can all live a better life and be financially free. Let's grow our wealth one step at a time together. We'll see you soon, guys. Take care.